Wyoming LLC
They're not going
first.
to be able to track their assets back to you. This is how we do it. We create that Wyoming LLC. Then, the thing about Wyoming and why I go there, Wyoming doesn't collect any information. They don't ask who is the manager, who is the member. None of that is collected like California does, or like Texas, or Oregon, or Washington. None of that information is collected because they don't ask for it. All they want to know is who is the registered agent. Well, it's not you, it's us. Anderson Sears is the registered agent. Who is the business, or what business address? We actually provide our clients a business address for their entity. So nothing ties back to them. So we get this anonymity shield set up. Then when we create these LLCs, so if this property here was in Georgia, it'd be a Georgia LLC. Maybe you got a second one in Georgia. Here's your Ohio LLC. Here's your Texas Limited Liability Company. And here's your property in Illinois, just like this. And then I set up all of these entities second, and they all point back to that Wyoming. So on that filing, rather than using our client's name there, we put the Wyoming LLC. We list it as the member of all of these structures. So if anybody looks at this entity right here that we set up in Georgia, if they were to go to the Georgia Secretary of State's website and pull up the entity name, it points them right back to here, to the Wyoming LLC. Now, they don't even know it's a Wyoming LLC. I have more slides if we have time later on. I'll show you that. They'll just see an LLC name. They have no idea where it's filed. They have to go and search for that as well. But nothing's going to point back to you. No one from an outside is going to trace these properties back through the structure to your Wyoming LLC and back out to you. It's extremely effective in creating the asset protection plan. So there's two steps here. Number one, for the residential real estate, set up separate LLCs for each property. Okay, and then you have each of those LLCs are going to be owned by a Wyoming LLC. So we do step one, create Wyoming LLC. This is really important. You got to get this one done first. Step two is to create these limited liability companies here. Step three is to deed the property out of your name and into the various LLCs. So yeah, you're going to be in the chain of title, but you're not going to be the one listed as the current owner of the property. Now, from an asset protection standpoint, how does this get modified depending on where you live? So I'm going to hit a few different states here just because I think it's important, because I saw where people were from. I saw there was a lot of people from Texas. So in Texas, we would do the same thing. So a Texas structure would look like this. Wyoming LLC. Maybe in Texas, we're going to create a series LLC because Texas is one of 22 states that recognize this type of structure. So a series LLC means you create one parent LLC here, the series that's owned by your Wyoming, and then we create what's the best color? Well, I'll just then we create structures what are called cells, and each of the cells will own the property like this. Now the cells for a series LLC are treated like separate limited liability companies. But the difference is, in this structure here, I have to file each of these companies with the Secretary of State. So I have to do an article of organization. But in Texas, I only have to register this entity. These entities over here don't get registered. It's just some paper that we put together for our clients to create the cells, but they're treated like a separate LLC from an asset protection standpoint. So if something happens in this cell, that's all you stand to risk. Right there is just that one cell. So Texas, we would look at a structure of using a series LLC. Now, what would I do in Colorado? Colorado, I would use separate limited liability companies. If I was in Florida, Florida's a little different. So in Florida, you can use land trusts. Land trusts are treated like LLCs from an asset protection standpoint. I know I haven't covered them yet, but I'll get into them a little bit later. So in Florida, I'll set up separate land trusts for each of the properties, because in Florida, it's the only state that allows this. In Florida, if I have a Florida land trust set up and something goes wrong here, the liability stays contained. Now, if this was Texas and I had a land trust in Delaware series typically, the cells, just as an added layer like that. So it reduces the number of entities a client has to set up. So Florida is going to be a tweak there. If you lived in Tennessee, so in Tennessee for single families, we would do the exact same thing. We would create a Wyoming LLC, then I'm going to create a Tennessee series, because Tennessee adopts a series. Then I'm going to create cells like this that are all owned by my client, so my client doesn't have to pay taxes, which is called a fonts tax, on the individual structures, but they have complete anonymity. So, I mean, I'm going through this kind of quick for you because I just want you to grasp this, that depending on where you're at, it's different. It's not a one-size-fits-all. Let's say you lived in California, which a lot of you do that are joining me. How would I structure you in California? Well, in California, I'm probably going to tell you to do this. If you own real estate in California, do a Wyoming statutory trust. Why am I going to tell you to do a Wyoming statutory trust in California? Because in California, you have to pay $800 per LLC. If you set up 5 LLCs, that's a $4,000 annual investment you're making. Or if I set you up a statutory trust, I don't have to pay that. Because the statutory trust is exempt from the franchise tax for California investors. So we'll do the exact same thing. We'll put properties like this into the statutory trust. We'll have them all owned down here by one Wyoming LLC. Okay? So I hope you're getting that. It's not a, as I say, it's not a one-size-fits-all. All right? And I know I see just that the questions are blowing up right now. I know they start blowing up when I go into this because people start running, oh, wow, this is new. I haven't heard that take on it before. You know, what about Michigan? I forget if Michigan has a series or not, but you know, we look at that when we're planning, when we're doing a strategy session for our clients to make the appropriate determination as what is the best structure for them, for what they have, and how it should come together. All right. Now, somebody brought up New York. So in New York, you can use LLCs, but maybe it's better we'll use a land trust or a limited partnership for a New York type structure, because if you want anonymity, it's harder to obtain anonymity with LLCs because New York changed their law 3 years ago to eliminate anonymity with limited liability companies when there's a real estate transfer. It's not on the Secretary of State, but it's at the county level. And I don't have time to go into that, but it was a dumb decision that's not based upon reality of reality, people understanding what actually goes on with entities. Okay, so this is asset protection. Now, I also said I'm going to talk to you about tax planning and business planning that goes along with this. So when we create a structure like that, one of the things you want to look at is how they're going to be set up from a tax structure standpoint. Each of these LLCs that are up here, okay, these LLCs will be disregarded. And what that means is that they don't have to file a federal tax return. So we structure them so that no tax return will have to be filed for any of these red boxes that are in your structure. You're down here, you own the blue box, the Wyoming LLC, right? You don't own the red boxes. You own the blue box owns the red box. Now, this box down here, well, from a tax and business planning standpoint, we're going to make that a partnership. I could make it potentially a disregarded, but I'm not going to do that. I'm going to make it a partnership, and you're actually going to file a tax return. You're going to file a 1065 tax return. Again, this is also a change from what we used to teach 10 years ago. Many times we would tell people, hey, we can set up a structure for you with 12 entities and you don't have to file a single tax return. Like, that's awesome. Let me get that set up because I always thought I had to file 12 returns. Well, the problem is that, again, I wasn't thinking with that business-minded point of view at that point in time. And I didn't realize that filing a return is important. And here's why. This is, again, really important for any real estate investor to get this. Okay, so from a tax standpoint, why do I want this filing of a tax return? Okay, if you didn't have it file a tax return and everything was disregarded, everything's going to show up on your 1040 Schedule E. So the IRS is going to look at it as if you own these properties in your own name. Now, the problem with that is that taxes by accelerating depreciation on your real estate. So what that in turn implies that, hey, I make a lot of money, but I pay no tax on it, right? So why am I not paying tax on it? Because my real estate depreciation wipes out my taxable income. That's why we call real estate a tax shelter. So the problem with that is when you start wiping out big chunks of income from your real estate investing, if it all flows down on your Schedule E, page 1, right down on your return, like you own the properties in your own name, you increase your risk of audit. Because a lot of auditors don't understand how this works. And so to put it on a finer point on that, when it comes to auditing, you have 1040 filers, which are individuals. If there's 1,000 auditors sitting in a room right now, about 990 of those are qualified to audit 1040s. Only 10 of them are qualified to audit 1065s or corporate returns, which are called 1120s. So just think on, if I'm being aggressive with my tax planning and wiping out my income with depreciation strategies, then when someone who is not as experienced in tax and accounting finds that on my return, are they more likely to audit me? Yeah. And even if it's 100%, you're able to do it, but why go through the process? Why put yourself in at that higher risk category? So from being audited, so from a tax perspective, this is what professional real estate investors do. They have a business mindset. They run their income through a 1065, and that gives them a K1 on their tax return, reduces their risk of audit. So that's from a tax standpoint why I like to do this. From the business standpoint, it's even more important. So from a business standpoint, this is where we talk about borrowing. So when you want to borrow money, your underwriter is going to run a debt-to-income analysis on you. How much money do you have? How much debt do you have, right? And then they're going to determine your ability to borrow. So if I had real estate that I owned in my own name, or through, say I had 10 properties in my own name, or through disregarded entities that show up like they're owned in my own name, that shit your tax return in the same place, and I show from those 10 properties, I make $100,000. If I went in to get a loan, the underwriter is most likely writing a Freddie Fannie conforming loan, because most of them do, because they want to sell them to Freddie Fannie. They're going to look at that 100K, and when they run my debt-to-income analysis, they're going to say, we can't count 100K, we can only count $75,000, because Freddie Fannie only allows us to count 75. We have to hold back 25% for vacancies. So you just lost 25% of your income in the calculation process, because you own your properties through disregarded LLCs, or you own them in your own name. People don't even realize this is going on behind the scenes, and they start running up against barriers of qualifying for more loans because they don't have the right income, enough income to qualify. So the way you turn the tables on this is you use this blue box down here in Wyoming as a partnership that gives you a K1. Now it hits your tax return, but it hits your tax return, that income hits your tax return in a different area. And where it hits your tax return is on Schedule E, page 2. So now I've got $100,000 on here for those Freddie Fannie conforming loans. Because it hits page 2, you get to keep 100% of that. See, this is what I learned from working with those unicorns years ago. I started understanding now how entities can help you do more, that if you set them up with certain attributes, it's going to propel your real estate investing. And I've seen it firsthand in my own investing, how when I finally made that shift, working with lenders, things started to drop quicker. Fewer questions were being asked. And Michael's going to talk about that when he talks about C corporations and paying salaries, how that's important as well for what you want to do. So these structures, as I just showed you, we talked about asset protection, we talked about business planning, we talked about tax planning. You want to ensure that you're hitting all three legs of this as you're putting it together to ensure that it's working for you. Now, if somebody asks, what about losses? Losses still flow through to this, to your return. It's where it hits your return. All we're doing is we're changing where it shows up on your 1040 to get you past the underwriters that you're going to be working with as you're trying to grow your business. So I love doing this stuff because it's so intriguing. I know some people are probably laughing. I didn't quite get that. Don't worry about that. Understand that when we're working with you, this is what we're doing for you. There's different ways to put it together. So that is single family residential. That's how we go about doing it. You're going to be using, as you set up more structures, you should be looking at creating one LLC per property. Like I said, I've got titanium clients that have, 10, 15, and we have one we set up 50 LLCs for last year in that type of structure for them, because they wanted to ensure that every asset was protected. And when you can approach it from that standpoint, where it's just a small investment, you create as many LLCs as you want, then it becomes even more beneficial. People see the reasoning behind the recommendations that we're making. But it's also key to have that one Wyoming LLC there. All right, so how would this change if you wanted to invest with a self-directed IRA or a 401k? So this is a scenario that maybe you have IRA assets and you're thinking about tapping into it. You want to put them into real estate. So two options here with an IRA. You can either roll it into what's called a self-directed IRA, okay, and that is with an institution or a third-party administrator that allows you to invest in real estate through an IRA. So if you had your traditional IRA over here, you would just open up a self-directed and transfer the funds in. Or you could do this. We like to set up solo 401. And you can do the exact same thing. Rather than move it to an IRA, you move it into your solo 401k. Now, what is the real distinction between these two? A lot of it comes down to control. Is that with a solo 401k, you're in control here of how the money gets invested. That means you get to handle all the transactions. In a self-directed IRA, you have to work through a IRA custodian to run the deals. You can't be the one doing it yourself directly. So either way, plan. I mean, we prefer this because there's other benefits that come from having a solo 401k. I mean, with your IRA, you can't borrow from it, but if you roll it into a solo 401k, you can start borrowing from your plan. You can borrow up to $50,000. You do have to repay it over 5 years, but when it's in an IRA or self-directed IRA, you don't have that flexibility. Another benefit is that if you want to use leverage, that is borrow money to invest in real estate. If you take your IRA and you put it in a solo 401k, you can use leverage, and there's no tax on the income. What do I mean by that? Because most people assume that there's tax on there's no tax on money that's generated inside of an IRA or a 401k plan. That's generally true. However, if you're using debt, then you have what is referred to as UDFI, unrelated debt financed income. And that's where a lot of self-directed IRA investors run into issues, that their IRAs are being taxed at 37% on the income they're generating, and they're shocked. They're going, I thought this was supposed to be tax deferred or tax free. It's a Roth. Typically it is, but if you're using debt because you want to leverage to buy more, it's not, unfortunately. Solo 401k, you can use debt all day long and you're not taxed on it. So a QRP is a solo 401k. Now, this 401k plan that you want to invest in real estate or your self-directed IRA, here's what you're going to do. You're never going to take property directly in the plan itself. That is a recipe for disaster, okay? Because if something goes wrong, then you've just not only risked the property, but any remaining cash inside of the plan. So another misconception that people have that have these types of assets is they think that it provides protection from creditors, that they can't be sued. That's incorrect. The pension itself can be sued. Pension plans are a huge owner of real estate in this country. The Wall Street Journal just had a article on Thursday about a development. This was done a while ago, and they just wrote an article on it. Doc Horton, a big national developer, built out this development in Texas and ended up selling all the homes. I think this one was sold to a pension plan that is just turning them into rentals. They're new single-family homes. They just turn them into rentals because they make more money doing it. They taught in that article, I forget how much, they basically doubled their profit or something, or made 2.5 times their profit by selling it to a pension fund that is then going to rent them out and generate income.
I think it was a 5 cap is what they were selling it at. So the idea here is that if something goes wrong with that property, then everything else in that plan's at risk. That's why with these structures, we're going to want to use an LLC to hold the real estate. So the same thing we would do in the other structures, we'll set up an LLC that's owned by the IRA or owned by the solo 401k to own the property. Now, also in this structure, we'll use multiple LLCs. So one LLC per property is the way you do it. You don't want to own the property directly in the plan name. Now, can you also use a Wyoming company here for anonymity? Absolutely, you can. You can definitely do that with this type of structure. So, for the most part, these limited liability companies are set up in the state where the property is located. So, if you're going to invest, if you want to invest with your solos, I mean, we set these solos up for people, and this is what we do. We get their money rolled into Schwab, and then we start deploying it. They start deploying it. We don't, because they have checkbook control over it, into LLCs that are owned by their solo 401k, or they do it through the self-directed IRA. But just key that that's what you're doing when you're setting this up. All right, so that right there is the residential real estate. Now, what about commercial real estate? How does that change if you're going to buy commercial? Now, the commercial stuff's going to be a little different, okay? And again, we want to look at all of those factors again that I talked about: asset protection, business planning, tax planning. I'll give you a story. This individual had been subscribing